So let me get the chart that we were showing you guys about Turkey. Now we're going to talk about the euro-dollar market as well very, very quickly. Okay, so we're going to talk about the Turkish and the euro-dollar market. Okay, so why are we talking about Turkey just now? Because it's obviously one of the biggest single drivers in the market just now. It's a very, very important driver because obviously it's driving a lot of concerns about a lot of different things. So when we're looking at the charts, so this is a very, very simple chart. It's got emerging markets on it, SPYM. And if you go into the compare and you were to type in SPYM, you'll see exactly what it is, not PIM, SPYM. You'll see exactly what it is. It's the emerging markets shares in Germany. So you can obviously see that this is a market that you can look at in terms of the European session. It's something that you can look at if you're in the European session, because obviously a lot of the emerging market ETFs aren't open because they're US priced ETFs. Now, to verify that this indeed is exactly the same as the emerging markets, then obviously you can use something like EEM, which is an iShares emerging market index fund in America. You can see EEM. So obviously if these two lines are pretty much the same, then you're going to be able to verify that the information is pretty much the same. And I think you'll agree with me that the two lines are pretty much exactly the same. The upticks are all the same as the upticks, the downticks are all the same as the same downticks, and therefore the SPYM is available to use in the London sessions as an effective emerging markets indicator. Now, one of the things you'll probably start to realize is that there's certain things drive the markets at different times during the trade cycle. And one of the things that drives the market, of course, is risk. And there's no bigger risk location than emerging markets, okay? So emerging markets have a very, very high degree of risk. They've got a very high degree of opportunity, but they have a very high degree of risk that comes with that opportunity. So when emerging markets start getting put under a little bit of pressure, for example, you can see emerging markets getting put under a lot of pressure here, for example. This could cause problems for the marketplace. This is a daily chart, remember. This is going back quite some time. If you're ever trying to prove a relationship, or if you're ever trying to understand a relationship, guys, you absolutely must get off the 5-minute charts into these daily charts. You must get into this chart, guys. It's going to give you a big, broad view of the market. It's going to give you a feel for the market like you'll never get from a 5-minute chart, okay? Get into the daily charts to find your big ideas, find the view of the marketplace, find the idea of whether we've got a bid coming in or an offer coming in, and then bring that down into your smaller time frame charts to find the right trade at the right price. Because the one thing that's true of this chart is that this down line isn't going to suddenly become an up line. It might not be as down by the end of the market close, but it's going to be a down line. Because on, in a 5-minute chart, there's going to be up lines and down lines and up lines and down lines and up lines, but it's all part of that big down line, isn't it? It's all part of the big down line. So if we know that there's a big downline here, then we can obviously look at that and say, well, what does that cause in terms of trade? What are we looking at in terms of trade? Now, the one thing you've got to say is, okay, well, what use is this line? What can I use this line for? What can I use emerging markets for? Well, what you can use emerging markets for, of course, is perhaps looking at value in the S&P. The S&P will not go up if emerging markets are crashing. The S&P will not go down unless the emerging markets crashing will obviously bring the broader markets down as well. If the emerging markets are finding a nice buyer, that's usually good for growth companies in America. So you can obviously expect the S&P to be rallying at that stage. So what it's good for is when you're looking at emerging markets, you can look at, a lot of the times you can just look at the amount of sell side pressure or buy side pressure that starts to creep into some top edges on equities or bottom edges on equities. So for example, the little change in the emerging markets just here, as this equity price made a new swing high, you can see that that's obviously a little bit risky. as the equities go into this new swing high here, there's a very high probability that there's going to be some correction in equities during the course of the next few days. And you can see obviously this was the correction coming in from the 14th of June, and the price obviously sells off really far during that process. Now, once the emerging markets had bottomed out from this point onwards, then obviously there was a high probability that the equity markets would then catch a bid again. And sure enough, the equity markets did catch a perfectly good bid. The price kept going higher. But just take a look at what's happening here again, guys. Look. You see what's happened again here? It's a simple line across the top edge of the chart. They're just exactly the same as what we did before. Can you see the problem on equities at the moment? Can you see what the problem is? It's emerging markets, isn't it? Well, there's a surprise. Of course it's emerging markets. We've obviously been talking a lot about Turkey, for example, and the problems that they're starting to face, about the possibility of a spike in credit risk or default risk in Turkey. So when we start seeing emerging markets diverging from equity prices, there's a problem, guys, and you've got to be aware of that problem. Now, one of the other things you can look at when you're looking at emerging markets is something very, very simple. You can look at how people rotate their money. If I'm an equity fund manager and it's a long-only fund, and there are plenty of long-only funds out there, big funds, billion-dollar funds, multi-billion-dollar funds, and I've got an equity-only fund, a long-only fund, and it's only equities. Then obviously I've got aggressive stocks, and I've got defensive stocks. I've got aggressive stocks and I've got defensive stocks. And obviously my allocation in this, depends upon whether I am very, very aggressive or very, very defensive, obviously. As I get defensive, the allocation comes out of aggressive and goes into defensive stocks. This is a long-only portfolio. And this is a very, very useful thing to be able to recognize, hopefully for you guys. It's a very useful thing for you guys to be able to recognize, because this rotation is worth billions of dollars every single day. You'll find that all the big players, Berkshire, all of these guys rotate in and out of different stocks, different sectors, according to how aggressively bullish are or how aggressively bearish they are. And obviously the very, very simple sectors that are aggressive stocks are places like discretionaries, emerging markets, of course, we've just talked about, financials, and even tech fits into this, industrial somewhere in between. In terms of defensive stocks, staples, obviously, staples. And the other defensive stock is utilities. The most used defensive stock is utilities. So we can start looking at these relationships inside of this environment, can't we? We can start looking at these relationships, because as Berkshire start to rotate from, for our example, discretionary stocks into staples, that's telling you that Berkshire's got billions of dollars to move, and they're starting to move it before equities has even started to move. Why is that the case? Why is that the case, guys? Think about it. Why have equities not started to move here? Why have equities not started to move? Why have equities not started to move? It's a very, very simple reason, guys, and it's not a trick question. Because the net money that's invested in the stock market is still invested in the stock market. Do you see that? The money's not leaving the equity markets, is it? Sounds simple, but a lot of people don't think about this. So there's $1 billion coming out of the aggressive stock, but it's going into the defensive stock. So if you're looking at the S&P, the S&P will possibly still be doing that. However, if I look at the say the aggressive stock was discretionary and if the defensive stock was staples, what's going to happen if I look at those individual sectors? Well, this is what's going to happen if I look at those individual sectors. Do you agree with that? Do you agree with that, guys? If this is the discretionaries against the staples, if this is discretionaries against staples, then obviously if I'm buying lots of staples and selling lots of discretionary, then obviously my discretionary stock is going to go down. My staples stocks are going to go up because there's billions of dollars going into that rotation, and it's going to cause this line to drop, isn't it? It's pretty simple. It's pretty simple. So when you look at a marketplace like this and you're looking at this equity top edge, you can see emerging markets are starting to come off, absolutely, but we can verify some of this stuff. Is Berkshire moving into defensive or attack? What are they doing? Let's take a look at equities recently. So we'll take this and we'll go one step forward, and we'll obviously look at XLY, and you'll see that XLY is discretionaries, consumer discretionary stocks, okay? And we'll look at XLP, which obviously is consumer staples, okay? So your consumer discretionary, if anybody doesn't know, discretionary are luxury items, for example, where there's a discretion as to whether you buy them or not. And obviously you're going to buy these types of things from these companies when you've got spare cash, when you're feeling good about stuff. So it's a sentiment trade, isn't it? This is very much a sentiment trade. If you're not feeling good about buying stuff, Gucci's not going to get very much business, Jimmy Choo's not going to get much business, and the people that are going to get a lot of business are obviously the energy companies, the foods, the foodstuffs, all these companies that sell staples. Utilities. These are the companies that are going to start getting a lot of money because they always get the same money every single time, regardless of a recession or regardless of a big movement in the outside markets. If it's really, really bullish, they still get some money, but when it's bad, they still get some money. Gucci don't get any money when things are bad. If you can't buy that Gucci pair of shoes or the Gucci sliders at $300, you're just going to pass on that, but you're not going to pass on getting your food for the next week, hopefully. You're not going to pass on getting your food for the next week. So when we put a relationship like this on the charts, one of the things you're going to be looking for is this relationship to confirm the actual chart itself. And one of the things you'll have seen into this top edge is that we've had a very, very substantial reversal out of discretionaries into staples. A very big reversal. If you look at the green line away back here yonder when we were in the middle of June, you can see that discretionaries were very, very high, staples were very, very low, and you can see that this relationship has been tapering off significantly recently, and that's giving you real cause for concern about equity top edges. Well, when you start adding the divergence in the emerging markets, which have got nothing to do with consumers and discretionaries and staples, has it? When you start adding that marketplace in here, and you can see this divergence, you're really starting to be concerned about this top edge going back to the 7th of August. You're starting to be really concerned. Now, if you go back to my tweets from the 7th of August, I have actually started to give out a lot of warnings at that stage that we were moving into hedge side business, and I don't care to go through all the tweets to find it, but you'll probably be aware that that's something that we have been talking about in significant detail, actually, in terms of the tweets and in terms of this room. So here's what you've got to be looking for, guys. And when you start drilling this down into the smaller time frames, of course, you're trying to find the examples of this developing. You're trying to find those types of situations developing on the small time frames. So when you move down into these shorter term time frames, you can see that obviously when the market opens, you can start seeing this green line is already starting to put some sell side pressure. You can see that you can see the early morning stocks coming in here, for example, on the London session. You can see the early morning push on this negativity coming into the marketplace, starting to push the prices hard to the downside. And obviously at that stage, you're just trying to read the market properly. You're just trying to read the market properly in terms of these rotations. And as I said, it's very, very important because on top of these rotations, you can add systemic risk. You can add in the TED spread, you can add in gold, you can add in bonds, you can add in dollar yen, you can add in euro yen, pound yen to try and find trade opportunities. Because obviously trade opportunities go along these types of lines, risk on, risk off, of course. So when we see, for example, discretionaries finding a strong bid, you would normally expect to see something like the Japanese yen finding an offer. You'd expect to see people rolling out of Japanese yen as a defensive posture trade into more of an attack posture trade, which could be something like the pound or the Aussie dollar, for example. So when you start seeing that these rotations, which obviously take months to develop into. I mean, they can take weeks and months to develop these rotations, but they are leading indicators of what's happening in the real world. Because you can't react to these things, guys. These big boys that have got billions of dollars to move in equity funds, they can't react to something that's happening. They forecast that something is happening and they slowly move into position. Their slow movement into position tells you what their opinion is. And we're not talking about the talking heads on CNBC. We're not talking about Forex Factory. We're not talking about any of these types of things. We're talking about guys that are putting billions of dollars of investment decisions on the line based on their analysis of what's happening. And obviously, you know, based on what their analysis is, this is going to create the movement of each of these lines. Discretionaries against staples, classic example of that situation, discretionaries against staples. Now obviously the thing that we were talking about earlier is Turkey. So if I'll just take off the discretionaries again and we'll take off the S&P, we'll go back to the daily chart here because I want to just show you this in the daily chart. This is emerging markets obviously, and you know, one of the emerging markets that's included in this basket is obviously going to be Turkey. So when we see dollar Turkey, for example, going bid, there's a very high probability that emerging markets will drop. Now take a look at this. It's obviously started to go bid here. It's still heavily bid here. Look at how bid it is. Is this not a great place to be selling this emerging markets fund? Of course it is. Massive opportunity to go short emerging markets, isn't it? And obviously the price dropping off of that level has just made you quite a lot of money. I mean, you could have made some nice money on emerging markets. If you traded EEM, for example, and you could see that the dollar is starting to kick off against the Turkish, and you can see the EEM at that stage is trading at what price? Let me just see it. $44.25. This morning it's trading $42.62. That's not bad. That's $1.60 on a $40 stock in 2 days. $1.60 on a $40 stock in 2 days. That's not bad at all, guys. That's about a 3% gain on a portfolio stock there that is absolutely fantastic by short selling the emerging markets. Now, what else could you trade if you know that there's a spike in emerging market risk? What else could you trade? You could obviously go long volatility products like VXX, for example. So if I can find a cheap VXX somewhere in this area here with the dollar starting to rattle to the upside here, if I can find a cheap VXX during this process, that might be a good trade for me, yeah? So obviously we could look at something like VXX to trade as a long trade as well, couldn't we? You'll see that VXX is the iPath 500, S&P 500, VIX short-term futures. So obviously you can look at that stock and say, well, if I'm going to buy that, I'm going to be excited about this possible trade here. And there's your buy opportunity. Look, you can see that the emerging markets are going up, but dollar Turkey is going up as well. That's the trade you want because that's going to push the volatility down because emerging markets at this stage are going up. But concern is also going up because of the dollar Turkish lira. And you can see that you could have bought VXX here at $28.15. And today it's trading at $30.60. That's a $2 profit on a $30 stock, guys, in 2 or 3 days. $2 profit on a $30 stock. That's not bad at all, is it? 7.5% profit, 6.5%, 7% profit, depending upon where you got in, inside of 2 or 3 days, non-leveraged. Non-leveraged. So there's a very, very nice opportunity to buy some cheap volatility, for example. Perfect opportunity to buy some cheap volatility into this bottom edge here. We're going to talk about volatility trading if anybody's got an interest in it as part of the equity segment, about buying and selling volatility, buying long volatility, buying short volatility at certain times, because that's part of the macroeconomic process that we look at in the classroom as well. We're going to be looking at the elements that go towards a good economic model that we're going to be using for equity decisions about risk on, risk off. Any questions on this one, guys? Any questions? Obviously, there's other things that we can use to find risk coming into the markets. We can use the TED spread. We can use the skew as well. You'll be aware that if there's a spike in the skew, this is also a sign of problems brewing. And the skew itself, remember guys, the skew is based around the 25 reversals. If you go into an option string, you'll find that the at-the-money options are 50 deltas. In other words, if the underlying goes up $1, the option will go up 50 cents. If the underlying goes down $1, the option will go down 50 cents. That's the 50 deltas. As you move out into these outside areas out here, for example, it moves down to maybe 25s and beyond. 25s and beyond. And obviously, what you're looking at when you move into these 25s and beyond deltas is you're looking at the big outside outlier risk. 25 deltas. You're looking at the outlier risk in these areas. And the pricing of that outlier risk creates a little bit of skew in the marketplace. Outlier risk is risk. If the outlier risk is increasing, risk is increasing. So when we look at this, index here, when we see the skew spiking higher, aggressively higher, we should obviously be very, very concerned about why they're pricing up outlier risk so aggressively. And obviously, in line with other things that are happening, that's going to be a very, very good signal for a possible top edge forming, especially when you see, for example, discretionary staples doing exactly the opposite. So when we start seeing discretionary staples dropping, when we see this spike risk, there's a very, very good chance that this is going to start forming a top edge on equities. And we're going to start seeing that opportunity to short equities for a very, very decent sell-off, for example. So these are all things you're going to learn, obviously, when we get into the classroom proper. You're going to start picking up all of this information. And obviously, we're going to be spending the whole day on it for a whole week. We're going to spend each day talking about these types of things. So that it's not as if you're going to have to rush to try and figure it out. You've got a whole week to figure it out because we're going to cover each subject for a week right through the course of this particular classroom. So one of the key aspects of this is just to get a feeling for the shape of the marketplace, just to get an overall view of the marketplace. It's a broad brush approach, but it's good enough for you guys. And when I say that, I don't mean it's in a negative way. I don't mean, well, you're going to have to just lump it. But it's good enough to start just getting the process right, the thought process right about what's happening, just to give you that better look at the marketplace that allows you to start finding at least better opportunities, to start putting some of the odds in your favor. And obviously once you start building into narratives, then it can start making a lot more sense. Just because this line is spiking higher doesn't mean equities are going to drop. And the reason for that is very simple. Equities might be at such a high price that they're just pricing the outliers more aggressively because they're expecting to see at least some profit taking. So there's always going to be a balance that you've got to remember. When you look at the market makers indicator, for example, you'll see very, very clearly that type of process, that type of idea. If I'm looking at a market, for example, if I'm a market maker and I'm pricing up a market, think about it. If I'm pricing up a market that's doing this, I'm going to be looking at that in terms of, well, what do I think the price is going to do? So, you know, I think that as it goes up here, I'm going to make it really cheap for people to be long the market, and I'm going to make it expensive to be short. So there's going to be a line that shows up like this. Now, obviously, what happens is, in most cases, that means that the market makers are now bearish and the price will expect to be rotated back off this. Now, as the price drops, and I start to look at this and I say, I don't mind this downtick, I think it's going to go back up, I'm going to make it very, very cheap for them to be sellers and very expensive to be buyers. And if it's cheap for sellers and expensive for buyers, this line will go back up again. So if I'm pricing, for example, the 25 deltas, this would make sense, wouldn't it? This line here, this red line, would make sense. Because obviously I'm making it cheap for people to keep selling into this, because I don't think it's going to keep going down. So it's cheap for people selling into this. Now obviously what can happen sometimes is you end up getting a situation like this, where the price comes back up and the market maker's saying, holy moly, I'm not sure about this anymore. And when you see that happening, of course, there's something changed in this market. No longer is this a fade top edge. No longer is this a fade top edge. And this is now an expected market break. Now we're getting ready to deal in terms of that kind of pop. So it's not about this line dropping or rising. It's about the relationship of the drop or rise to what actually is happening in the background. And if that makes sense to you, then obviously you're already well on your way to kind of figuring out a lot about institutional trading. It's not about one line, it's about the reaction to the line, and it's about the line's reaction. Sometimes some lines lag, sometimes some lines lead, and it's about your ability to start finding the market that's driving the information background. For example, Turkey, emerging markets, is driving just now, so just by looking and watching them, it enabled us to buy the pound this morning with a lot of confidence. It had enabled us to buy the euro this morning with a lot of confidence. And we were able to get the right trade at the right price, make the money, and walk away from the trade for the morning session. Beautiful. Very important. Let's take a little break, and when we come back, we'll talk about euro dollar very quickly, and then that'll finish us off, and then we'll be getting ready for classroom tonight. So we'll talk about euro dollar. 2-minute break, guys.